2022 has been a very rough year for equity markets worldwide. Right here, I've got the S&P 500 on a total return basis, pulled up in Morningstar using the Vanguard S&P 500 mutual fund, ticker symbol VFINX as the proxy. And we can see that since the end of 2021, it has basically been a downhill and bumpy ride for the S&P 500. In global markets, all follow basically the same trajectory. Downhill, very rough, highly volatile. If we set this year to date, we can see the S&P 500 down a little over 14%, and looks like it had a max drawdown here in mid-October of 24.1%. All the while, all throughout the year, highly volatile. So this had me wondering, what has done well in 2022, specifically with regards to factor investing or alternatives to market cap weighting. Now, for those of you guys that may not be familiar with it, factor investing is things like value and momentum, which in academic research have shown to deliver excess returns above market beta or market cap weighting. And whether that is robust and will persist going forward in the future has been the topic of much debate. But for now, I just wanted to take a look and see how things have done, how things are stacking up in 2022. Was there alpha anywhere, right? So let's take a look at this here, and we will start with momentum. I'm going to use iShares Momentum Factor ETF, MTUM. And, I'm going to keep this all relative to large cap US equities, which is what the S&P 500 is. And we can see momentum is done basically about the same as the S&P 500, down 15.67%. So down a little bit more than the S&P 500. I wouldn't say that's a material difference, right? Like if you're in 100% S&P 500 or 100% momentum, as represented by MTUM, there's not a life-changing difference between the two of them. Pretty close, and that's to be expected. There's usually a strong correlation between market capitalization weighting and momentum as a factor. Now let's look at value. And for this, I'm going to use Vanguard's Large Cap Value Mutual Fund, which I think is VIVAX. There it is, Vanguard Value Index. And whoa, it is actually positive this year. I was not expecting it to be positive. I was expecting it to be a little bit higher, not quite down as much as market cap, not quite down as much as the S&P 500. I was not expecting it to be positive in the green here. That said, it's barely positive, but value is actually doing quite well, and that's to be expected. When market cap weighting is down, usually value is not down as much, or it's kind of having its time to shine. If we set this back though, and we look through, let's just say from 2015, I'm just picking a random date here, we'll probably see, value has underperformed the S&P 500, and that's characteristic. When market capitalization weighting and momentum are rip-roaring up, value is kind of lagging usually, and that is the case as we are seeing here for the last 7 years or so. If we go further back, let's just go back to the early 2000s here. Now, this is when things will be interesting. Because during this period, market capitalization weighting was getting crushed, value was doing very well. And that's kind of like what we're experiencing here in 2022. I'm just going to go back to, we'll just look at the whole decade of the 2000s, otherwise known as the lost decade. And that is because the S&P 500, I think, was at about break even over that whole 10-year period, if not down a little bit. Yeah, so through the lost decade here, mind you, the momentum ETF did not exist. The S&P 500 was down about 10%, whereas value as a factor represented by Vanguard's Large Value ETF was up 13%. So you can see the difference between the market cap weighting and value. There's very low correlation between the two, and we're seeing a similar pattern, or we're seeing this pattern play out here in 2022. And I always like looking at this chart here through the 2000s when, market cap weighting in the S&P 500 was getting crushed. Value was fairly resilient and really added some diversification value to the portfolio. Okay, so let's go back to 2022, click on year to date and see things. Value is done very well in 2022. Let's look up quality. Let's put quality as a factor on here. And quality is usually more correlated with value than it is with momentum or market cap weighting. So we're looking at an iShares Quality ETF, and whoa, it is down 17%. I was not expecting that. I was expecting to see quality up here in line with value. So that's very interesting to me. Quality is not doing so well. How's quality done over the last 5 years as a factor? Okay, so quality was basically just keeping up with market cap weighting, the whole ride up, keeping up with the S&P 500. It was outperforming value. That's interesting to me. I was associating quality more with value, but it seems like currently quality is more closely correlated to market cap weighting. This has me wanting to look at one other thing, and that is the COWS ETF, COWZ ETF. And I made a video on that, and that one really caught my attention because it's a free cash flow ETF. So it chooses its holdings quantitatively based on a screening of free cash flow and then a weighting behind that. And I really like that ETF because as an investor, I am all about free cash flow. And I say that more as a small business investor than a stock market investor. For those of you guys that don't know me, the primary bread and butter in my life comes through small business acquisition and entrepreneurship. So when I'm buying those businesses, I'm looking at how much cash flow does this thing spit off relative to the price I'm paying for it. And that is like the number one driver behind the valuation of those businesses. And that has done very well in my life. And that subsequently, I think, spills over to what I'm interested in the stock market. Okay, and that's that free cash flow. So I made a video on the COWS ETF. You can look for it on my YouTube channel. I think it's one of the more popular videos. And I've always thought that ETF was very interesting. And I think that personally, and this is my own, in my head kind of thoughts, is that at the end of the day, investments always come back to what do they ultimately spit back out, or what does the business have to reinvest? Like, it always comes back to cash flow. And, mind you, there are going to be some tech investors out there that'll tell me I'm wrong. Right now, they're going to look wrong. I'm not going to look wrong. But I just fundamentally like the concept of free cash flow. And this is kind of an aside note. If you're trying to build a portfolio or trying to establish what you're going to hold in your portfolio, something that has to be considered is, what are you going to live with? Right? Like, there's no wrong answer out there. Like, if you have a deep conviction to value, fuck it, invest in value. If you have a deep conviction to momentum, fuck it, invest in momentum. Right? Like, if you're constantly going to be looking at your portfolio saying, oh my God, value is outperforming, right? Or, oh my God, I could be outperforming if I were in momentum, just invest in that. The worst thing you can do is have no exposure to equities, right? Even if you underperform the S&P 500 or whatever benchmark you're using, even if you underperform it, that is not necessarily a bad thing, as long as you are just not keeping cash on the sidelines. So while statistically, maybe you're going to be better off in market cap weighting if, investing in free cash flow ETF like COWS, COWZ, and I don't mean to turn this into a promo video for COWZ. If that is what keeps you invested and that's what keeps you sane, then do that. That is one thing I think a lot of people don't consider. Or maybe, go half index fund market cap weighted, half in whatever factors you think are doing well. So let's put COWS on the chart here. Whoa, COWS is up over the last 5 years. It's up a lot, and that's came a lot in 2022. Yeah, so 2022 COWZ, the free cash flow ETF, up 5.5%. I was not expecting it to be up this high, and this just makes this video seem like a promo for COWZ. It is not. I'm not in any way affiliated with them other than I have a personal interest in that ETF because of my philosophy that I just explained. That said, I actually do not hold any COWZ ETF at all. I literally have no COWZ ETF, but I like seeing that it is positive. And again, when we're in these times of market turbulence and people are worried about downside, investing in those companies that are generating cash has historically done quite well. I don't have all the, back-tested data pulled up on COWS right now. You can probably see that in my COWZ video, but in the early 2000s as well, COWZ, or the backtest of its quantitative strategy had done well. Now, I think the most shocking thing to me on this chart is the underperformance of the QUAL quality ETF. I was really not expecting this to be down so much at all. I mean, because, again, people want to invest in quality companies, and that's essentially what COWZ is. Its just measure of quality is how much free cash flow are they putting off. Off the top of my head, I'm not too familiar with what QUAL is doing right now or what their methodology is behind it. So yeah, I'm surprised by that. While we're kind of on this topic of quality and free cash flow, let's just put another one on here that has been of interest, and that is MOAT. Now, MOAT is Morningstar's MOAT ETF. It's often touted as a Buffett-like strategy. There's another thing we can put on there. We can put Buffett's Berkshire company on here. But it's often touted as a Buffett ETF. How's this thing doing? And the one reason why I really don't like MOAT, I think it's interesting, but I really don't like it as a holding is it's not purely quantitative. If you look at the methodology behind it, Morningstar basically just says, we use our own proprietary measurements to establish a moat. How is moat doing? And moat doing a little bit better than the S&P 500, but again, not anything crazy, radical, or different. So, I said we could put BRK on here, Berkshire Hathaway, BRK. Let's take a look at that. I am curious how that's doing. That is, again, regarded more of a quality or moat-like holding. That's Buffett's general strategy, often with some value incorporated in it here. And there it is. So this chart's getting kind of messy. We're going to cut momentum off of there. Quality, I guess we'll leave on there. Cows, we'll leave on there. Yeah, we'll just leave it on there as it is. Everything we got, we'll leave on there now. I took momentum off. And here we can see Berkshire Hathaway up a little over 5.5%, almost at 6%. So that's very interesting. So Buffett's strategy of quality companies at a value is fundamentally doing well. And he has got to be happy because I know over the last 5 years also, he has not been doing too well. So Berkshire Hathaway being that purple line, right? That is the purple line. Yeah, it looks like the purple line. Yeah. So over the last few years, it has been I don't want to say an underperforming. Well, it has been a little bit of an underperforming road, certainly through the COVID spike when market cap weighting was really rip-roaring up. It was kind of underperforming things. And now it's catching back up. If we set this back 10 years, this is going to be a rough 10 years here. I'm just going to go back to 2012 and click a date. BRKA up 268% versus the S&P 500, 242%. So Berkshire Hathaway, after a period of underperformance, is back to outperforming the S&P 500. So overall, I find this pretty interesting here. This is really interesting to see what's happening in the markets in 2022 when market cap weighting is getting crushed. Again, this is not investment advice. I'm not using this to make any investments. This is simply just looking at it here because I find this stuff incredibly, incredibly interesting. So what are your thoughts, guys? Let me know in the comments below. If there's anything you feel like I missed, or if there's any factors that have really done well or really done poorly in 2022, let me know in the comments below. Hope you found this one helpful and insightful. If you did, be sure to do me a sweet one. Hit that like and subscribe button. I'm signing off on this.